China did not send armies into Europe. It did not build military bases or raise its flag over any European capital. And yet, its presence is becoming impossible to ignore. Chinese companies now operate inside European ports, power grids, telecommunications networks, supply chains, and parts of the continent's critical infrastructure. This is not a traditional occupation. It is something quieter, more patient, a form of expansion where companies replace tanks, investments replace missiles, and long-term contracts replace military alliances. And over time, that influence can become extremely difficult to reverse. In this documentary, we attempt to answer one central question. How did Chinese companies become instruments of strategic influence inside Europe? China's focus on Europe was never accidental. It was a calculated strategic decision. The European Union is one of the largest economic markets in the world, with advanced infrastructure and hundreds of millions of consumers. But the real opportunity emerged during Europe's economic crises. After the 2008 financial crash, the Eurozone debt crisis, and later the COVID-19 pandemic, many European governments faced severe financial pressure and urgently needed outside capital. China arrived at exactly the right moment. Between 2010 and 2022, Chinese investment in Europe exceeded 120 billion euros. But Beijing did not treat Europe as one unified bloc. It treated it as a collection of countries with different weaknesses, priorities, and economic needs. Countries such as Greece, Italy, and Portugal became more open to Chinese investment because of financial pressure, while wealthier European states remained more cautious. That imbalance created a major strategic opening. The absence of a unified European position allowed China to negotiate country by country. Each deal looked economic on its own, but together they formed something much larger, a growing network of influence across Europe. And this raises an important question. Are Chinese companies truly independent businesses, or are they indirect extensions of the Chinese state? Inside China's political system, separating the state from major corporations is extremely difficult. Many large Chinese firms operate within long-term national strategies connected to Beijing's geopolitical goals. At first, Europe largely treated these companies as ordinary investors. But over time, the distinction became harder to ignore. A Chinese company investing in a port or energy grid is not simply buying an asset. It is securing a long-term strategic position inside critical infrastructure, and many of these agreements last decades. That creates dependence that cannot easily be reversed. This is where the European dilemma begins. European economies were built on the assumption that markets are politically neutral. But China operates differently. Economic expansion and state strategy often move together. As a result, several European governments began asking a different question: is Europe facing normal economic competition or a completely different model of geopolitical influence? One of the first sectors to expose the scale of China's expansion was maritime infrastructure. Ports are not just commercial facilities. They are strategic gateways controlling trade routes, supply chains, and sometimes even military logistics. China understood that early. That is why Beijing invested heavily in European ports. The clearest example is Greece's Port of Piraeus. In 2016, the Chinese state-owned company, COSCO, acquired a controlling stake in the port. At the time, Greece was overwhelmed by debt and urgently needed investment. Chinese money was viewed as an economic lifeline. Within less than a decade, Piraeus transformed into one of the busiest ports in the Mediterranean. But Piraeus was only the beginning. Today, Chinese companies hold ownership stakes or management roles in ports across Italy, Spain, Belgium, and the Netherlands. And the concern is not ownership alone, it is operational control. When logistics systems and supply chains become integrated into a global Chinese network, dependence gradually begins to form. And during geopolitical crises, strategic infrastructure can become leverage. After ports, China expanded into an even more sensitive sector: energy. Because energy infrastructure creates long-term dependence. Chinese firms acquired major stakes in parts of Europe's electricity sector, including projects in Portugal and Greece. At the same time, Chinese companies expanded aggressively into renewable energy projects across southern Europe. Their advantages were simple: lower prices, faster execution, and strong state-backed financing. But European concerns went beyond electricity production. The real concern involved maintenance systems, software access, operational control, and long-term dependence. When a country relies on a foreign company to maintain critical infrastructure, political tensions suddenly become far more serious. China has never openly weaponized that leverage, but the mere possibility changes strategic calculations. And if energy controls electricity, then technology controls information. That is why telecommunications became one of the most controversial areas of Chinese expansion. Over the past decade, Chinese companies expanded rapidly into Europe's telecom infrastructure, especially through 4G and later 5G networks. Before restrictions were introduced, Chinese equipment existed inside large parts of Europe's communication systems. And 5G networks are not just about smartphones. They form the backbone of smart cities, autonomous vehicles, industrial automation, and future digital economies. As concerns grew, Europe faced a difficult dilemma. Replacing Chinese equipment could cost tens of billions of euros. That financial reality slowed decision-making across the continent. The issue was never limited to direct espionage. It also involved data access, infrastructure vulnerability, and the possibility of pressure during geopolitical crises. What began as a technical debate slowly evolved into a question of sovereignty. Europe found itself trapped between two difficult choices: continue relying on technology linked to security concerns, or pay an enormous economic price to reduce that dependence. One of the biggest reasons behind China's success in Europe was the absence of a unified European strategy. Some countries viewed China mainly as an economic opportunity. Others increasingly viewed it as a strategic challenge. Countries struggling with debt and weak growth welcomed Chinese financing. Meanwhile, stronger European economies approached Beijing with greater caution. China did not need to divide Europe deliberately. It simply benefited from divisions that already existed. By negotiating country by country, Beijing reduced Europe's ability to respond collectively. And over time, this created a complicated web of economic relationships that became increasingly difficult to untangle. As concerns continued growing, Europe slowly began reassessing its approach. The European Union introduced new mechanisms to screen foreign investment in sensitive sectors, such as infrastructure, energy, and technology. But Europe reacted late. By the time restrictions were introduced, many strategic assets were already under Chinese ownership, management, or long-term contractual control. Reversing that influence quickly would be extremely expensive. As a result, Europe's strategy gradually shifted. The goal was no longer preventing Chinese expansion entirely. It became managing the risks associated with it. That shift reflected an uncomfortable realization. Once economic influence becomes deeply embedded, removing it carries a very high cost. This leads to the most important question of all. Is China carrying out a form of economic occupation? Or is this simply globalization working exactly